Sambre joins us now. Let's take our conversation forward. He represents DSP Mutual Funds. Vinit, good morning. Thank you for joining us. It's an all-time high on the Nifty. It's an all-time high on the Bank Nifty. But nobody's feeling happy, excited. Everybody is saying, we missed the rally. Is that the real way of looking at the market, that you can see an all-time high, but you cannot feel the all-time high?
No, I think we all are feeling also it's an all-time high, but nonetheless, I think the bigger issue is people generally are cautious about the kind of valuations we are scaling versus let's say the global markets, and not particularly so much worried about the relative valuation, but also from the perspective that there are some of these global worries which could have impact across the world. The fear of recession probably sometimes mid next year, the interest rates remaining longer. Now it's very difficult to fathom as to how much of that has got really factored in terms of the valuations today. But I think broadly, these are some of the concerns which are pretty much valid, so to say, as far as the markets are concerned. But the way we think about the markets really, Nikunj, is the fact that we are in a sort of a bull economy, I can say, not markets. We're in a bull economy over the next 4-5 years. And every dip is actually going to see more, buying into our markets. Global investors, when we interact with them, they show a lot of keenness and interest. Just that they are more skeptics about the valuations, the oil price, and all of that. So I think all of these things should be taken care when we think about the growth over the next few years. And when the markets are suggesting to you that they are buy on declines, it means that we are in a bull market, and hence one should be okay. Now, the other thing to sort of beat the high valuations, personally, if you ask me, is the investors need to first sort of be ready and prepared to see, spending more time to see decent returns. And in the interim, there could be volatility, which one should be ready to bear in a mind. And the other important factor is, even when we look at the market's valuation, there are contrasts which we see within the segments. There are segments which are reasonably valued. There are segments where there are excesses. So I think it's a balance which, as a fund manager, one needs to, build into the portfolio.
So let's be specific. Where are excesses in the market, and where you see opportunity in the market? What is your high conviction idea, and where are you looking at what others are not looking at?
So I think, frankly, when we look at the markets valuations, today pharmaceutical sector is one which I believe is sort of very structural sector to me. There is good amount of opportunity, and Indian companies, they have shown their strength supplying the products globally at low cost. Now, they are facing some challenges last 1 or 2 years post-pandemic, and I believe that these are all business cycles. Today, the cycles are not very favorable, but once the cycle turns, the valuations looks pretty attractive, and not that these companies have derailed in terms of their cash flow generation, the ROEs. Just that the profit is sort of stabilizing at current levels and creating a good base for the next 1 or 2 years. So I think that those, let's say pharmaceutical is one segment there. Banking is the other segment where, if you look at the overall performance of the banks, even the mid-sized banks, large banks, I think all of them are collectively, they have cleaned up the balance sheet, which is a very big cleanup, is what I can say. And now they are poised for decent credit growth over the next few years as we see expansion of economy taking place. Plus the margins have stabilized, the credit cost is under control. So, and when looks at the valuations, they are lower than the prior averages what they were trading at. So I think that's one category which really deserves to be looked at from that perspective. IT sector is something which, from the highs they have corrected, still trading higher than the 5 years averages. But I would say the next 1 or 2 quarters may provide an opportunity as the global worries maybe treat some of these stocks more unfairly over the next 1 or 2 quarters. I think that's a point where one can think of enhancing the exposure. So I think that's how we are sort of focusing on a few segments which looks okay and reasonable, just that the cycles are not so positive, and there will be waiting time in these segments. There are segments which have seen maybe front ending of the returns taking place, maybe engineering, which has a good long term outlook, but the returns have come about quite too early. Segments like consumer durables, where we are seeing the valuations have not corrected and are not reflecting the current picture, which is some slowdown seen in the overall consumption. The competitive pressure is very high, and the inability of the companies to pass on the pricing. So that is leading to margin contraction, and those probably are not getting fully reflected in the valuations. So I think these are some of the excesses which we are seeing broadly as far as these segments are concerned.
Vinit, hi, morning. So tell me a little bit more about what is it that you've been doing in your mid and small cap funds. Any new buys and sells?
Yeah, so the sectors which I mentioned broadly, what we are trying to do is keep on sort of accumulating the businesses which we like over a long term, and where the valuations are reasonable. And for somewhere we also feel that there is the valuations may be high, but the visibility and longevity of growth is there for us to see. I mean, those are the areas where we are okay assigning slightly higher multiples. So let's say some of the urban consumption stories which are still doing okay and we believe should continue, the retail malls, etc. I think those type of businesses we are pretty much happy owning and accumulating. I think also there is merit in actually looking at one more category which is right now getting penalized, is let's say the FMCG, which is more linked to the rural consumption growth. And as of now, what we see is that the rural consumption or the entry level consumption businesses are getting impacted because of the because the pockets of these people have got impacted quite a bit due to inflation. Our sense is that as closer to the budget and as we near the election in 2024, it will be imperative for the government to actually build a much more balanced growth environment and push some of the rural growth as well. And that's the point where some of these categories should also start showing up. So I think wherever we see opportunities of that kind, which are more rural driven and the valuations are becoming okay, we don't mind accumulating those businesses as well.
Hi, morning. Did I miss autos? Because that's a sector, auto ancillary as well, that the fund has fairly decent exposure to. But are you not worried about semiconductor shortages, labor shortage, perhaps supply challenges as well that could plague the sector?
No, absolutely. I think that's the kind of worry which we also have in terms of the supply chains still not fully repaired, and companies talking about their business being impacted. So I think that's one worry for us which we have in mind at the back of the mind. But one bigger picture there, while we have exposure to auto ancillary, we believe that both in India and globally, auto is actually in the down cycle for the last 2-3 years, and it's if we look at the trough, the cycle has seen actually it's quite low. I mean, it's decadal low, and from here we believe that whenever the recovery takes place, the kind of recovery which will happen here can be very sharp and good, and it will be durable as well for 3-4 years is what we feel. So from that perspective, we're trying to look at companies and businesses where they will sort of not be also affected because of the EV transition. So technology neutral type of companies, and wanting to play the sharp cycle recovery as and when it takes place.
Okay, so that's autos that you did not miss out on. I wanted to also talk to you about the new buys that we've seen, which is Triveni Engineering as well as Dhanuka Agritech, which is part of the DSP Small Cap Fund. The question I want to ask you is, what's the larger plan when it comes to commodities, particularly agri-commodities?
Yeah, so I spoke about the agri side just a while back, and our overall experience and our analysis also suggests that agri is a huge opportunity as far as India is concerned. We are the second largest agricultural market across the world, And if we look at some of the metrics, we are very poorly fed in terms of the yields, maybe production, maybe usage of mechanization and all of these. So we believe that there is a good opportunities, and companies here again, the names which you mentioned, I think we are talking of companies which have created very good wider distribution for their products, good brands. And again, just like the pharmaceutical companies, these are the segments which are trading pretty reasonable in terms of the valuations. Also, when we talk of sugar as a sector, I think there is a big transition which is taking place because of the ethanol play, where we see that more structural in nature, which is not currently being recognized by the markets. Markets generally tend to give low multiples because of sugar business, but I think ethanol is going to overtake the sugar profitability over the next 2 or 3 years. That's the kind of opportunity, and it's more structural, so which actually deserves to trade at let's say premium multiples. So I think these are again some of the bigger opportunities which we would like to tap through a few of our funds.
Vinit Sambre, the other question I want to ask you is, and get your views, and that is on is there a case for re-rating of PSUs? And are you folks doing that? Whether you look at the railway stocks, whether you look at the defense stocks, you could also look at the PSU banking stocks and their outperformance.
So, see, surely, first of all, one should ideally, not make a differentiation between different types of companies, PSU private. The differentiation arises because of the operating metrics. Now, what we have broadly observed in case of PSU businesses is that the operating metrics tend to generally, be poor as compared to their private counterparts. Now, which is where the PSU businesses have tended to trade at lower multiples than the private sector. And there are cases where some of the PSUs have shown their capabilities to improve their operating metrics and become more comparable, just like their private counterparts, and which is where the re-rating potential takes place. Now, for us, that has been one of the primary criterias of stock selection across the board. Let's say defense, railway containerization company, PSU banks. We have looked at businesses which have inflected, where the metrics have improved, and I think there we are not hesitant to take exposure. In some cases, we have decent exposure. In some cases, we start with smaller exposure. But I think the principal criteria is that the operating metrics need to give us that kind of confidence around these businesses, and that's where we are open to sort of look at the PSUs. But as you rightly mentioned, we have been selective, and for the reasons as I enumerated, I think those factors, changing, we definitely take a look at those.
Vinit, great to have you on the show. Thanks as always for taking the time out. Let's just see where the market has settled in at. And
Thank you.